Cross-asset analysis. We're going to be spending a bit of time on this one, and you're going to see a worked example at the end. So this is essentially what I use to do most of the research. Have a correlation table looking at the different assets that we have and the correlations over 15, 30, 90, and 120-day periods. The 1 year rolling correlation high and low table, that's probably not really useful. I don't use it personally, but the price correlation chart down here, it can be a little bit useful. You can see where the trends in the assets are coming from. Just over the 30-day period, you can see this one, for example, the stock market is currently quite highly correlated to Bitcoin, and gold is quite highly inversely correlated. And generally, if I'm looking at these correlation tables, I'm putting a lot of emphasis on correlations closer to the present. This is going to give me a little more signal, a little more idea of where the correlations are shifting. Potentially paying attention to how they change on a day-to-day basis is also very important. But it depends on just how much data you can handle in your brain at any one particular point. What I actually do is I put these all into my own table, and then I figure out the averages of all the different assets. So that helps me out a little bit in my own personal research. So what I do is I keep those in mind, and I say to myself, well, which one's looking the highest correlation? Highest correlation, positive or negative? Negative can be useful too, just as useful as positive correlation. And say, well, the stock market is looking very positively correlated at the moment, so I'm going to use that one, and I'll keep that in my mind. So what I'll do is I'll go to the charts and I'll look at, say, small caps or large caps, and say, well, what do I think the bias is for these? And if they're ranging, I might say to myself, well, if it's positively correlated and it looks like it's at the top of the range, it might just go down. And if it's correlated to Bitcoin, that means Bitcoin will go down too. Obviously, small caps are looking a little bit easier than the large caps. I mean, large caps could just continue drifting up higher like that, and that would cause Bitcoin to go up as well. So whether it goes up or down, that one's a little less certain. This one seemed a little more certain to me because of the risk ranges, which I'll go into. But also, there's a classic inverse correlation to Bitcoin as well, which is that when the US dollar becomes stronger, Bitcoin becomes weaker. I was considering that if the stock market was to fall, we might see something like this towards the top of the risk range, which would probably indicate that Bitcoin would fall as well if the correlation, the historical correlation, was to maintain. But here's the caveat. Did you notice how the US dollar correlation wasn't very strong across any of these time horizons here? We didn't have any correlations that were above or below 0.5. So while it was positive, you can see here 0.2 and 0.3, it wasn't exceptionally strong. So it was possible that that could have had some effect, but definitely not as much as effect as the stock market. So moving onwards, this gave me a bit of a bias for where Bitcoin might be going, especially due to the run-up that we had. Generally, my ethos is performance attracts leverage and leverage attracts liquidations. So for a sustainable rally, I suspected leading up to this point that because my bias for the stock market was negative, or at least less bullish than I had been previously, that we might see a sustained decline in both stocks and Bitcoin. And it may look something like this, also to compensate for this recent rally that we had. So what I'm going to do now, and that's obviously in the context of these risk ranges as well. So what we're going to do now is we're actually going to go over to the charts, and we're going to look at how this actually played out, and we're going to look at how I would manage my correlations in the current moment. So in practice, I'm going to show a worked example. The current correlation table, as you can see, is different to the one in the slide because it was made about last week sometime. So what I did is I actually took these correlations and I pumped them into my own correlation table, and basically determined the average. This is the way I like to do it personally. This isn't absolutely necessary. If you just wanted to, you could probably just run the 15-day correlations and just look at those on your chart if you really wanted to. and maybe 30 days and not worry about the 90 and 120 days. But me personally, because I just love the more data, the better. I just took the average of all the different correlations for each of these assets, and yeah, that kind of guides my decision making then. So at the moment, we have a strong correlation to the stock market and a strong negative correlation to gold. Interesting one. So we're going to keep those in mind as we move forwards. So looking at Bitcoin and where I had the charts set up with the squiggle, you can kind of see that my guess was kind of right. It definitely wasn't perfectly accurate. And I would say that my suspicions of this drop are probably no longer accurate. I mean, we might see some sort of a liquidation down here, but it would have to be exceptionally fast. If I'm doing this in real time now, what I'll do is I'll move this over to the side. And I would say my new bias would probably be something ridiculous like that. Just a quick wick and then a pump. But this isn't about my predictions for Bitcoin necessarily. This is about how we're doing correlations. So stock market and gold. If we're looking at the stock market, you can see that it didn't go down very much at all, and it's shot straight back up again. Actually haven't updated these ranges since last week. You can see small caps as well. My prediction there was absolutely wrong, which is fine because I wasn't trading small caps. I was just trying to deduce what their correlations might mean for Bitcoin. And I do most of the directional betting using these risk ranges, which I'll expand on in a moment. Gold is probably the most interesting one because if you remember from our table, stock market is very highly correlated positive, but we also have the gold, which is negative currently over pretty much all horizons except for 15 days. So if we're looking at this one right now and gold is looking quite expensive, then that means that there's a probability that it might come down to the bottom of this range again, which would indicate that there's a potential pump in Bitcoin that could come up. So we might see something like this. And as that comes down, that causes Bitcoin to rise because the two are inversely correlated. So yeah, something like that would probably be all right. And yeah, so essentially every single day, or as often as I can, I redo these risk ranges so that I have an approximation of what the potential for that asset to do is. I do this with the dollar as well. You can see my bet on the dollar was wrong. Not that I was betting on it; it was just an assumption, kind of figuring out what might happen if the stock market was to fall. And for example, if we had something like this, let's just do, excuse me. Let's just do an example and say that currently we were in a regime where the dollar was very positively correlated. No, let's say it's inversely correlated to Bitcoin because that's the classic example. And it was something like this, where we had the dollar at the very bottom of its risk range and we had a lot of airspace going up. Then I would be suspicious, very, very suspicious of any rally in Bitcoin if this wasn't going to drop any further. If Bitcoin started to rise and this didn't budge and we had a very strong negative correlation at the time, I'd be like, oh, well, if this goes up like this, which it might, because, it could be following this kind of pattern here where it's ranging around, then we would be very, very suspicious of Bitcoin and might say to ourselves, well, we might expect something like this then. Because, like I mentioned, the dollar and Bitcoin move in opposite directions, generally speaking. That's the classic correlation. Obviously, what we're trying to do is we're trying to compare this against the correlations that we have to say whether or not it's strong at the moment. You can see that there's virtually no correlation here to the dollar itself. So this is a correlation we wouldn't necessarily need to worry about. So yeah, this is how I perform my correlation analysis. This actually forms quite a large part of my analysis at the moment with my swing trading when it comes to shorter term stuff. So you might be asking, well, where do I get these ranges from? Because these ranges are the only tool that I use when it comes to charting. I use nothing else. You'll see that when I go to stocks, when I go to small caps, when I go to VIX, when I go to bonds, these lines are the only lines on my chart, because at the end of the day, they're the only ones that they're the only tools that provide any signal. You can find these tools at myfractalrange.com, or you can get them from Hedgeye. Hedgeye provides these ranges in their crypto quant email for Bitcoin and for Ethereum. If you want to have multi-asset stuff, you need to purchase their risk range signals as well. But if you want them for free, they're a little bit lower quality. You can go to myfractalrange.com. And yeah, so you can basically do this analysis on your own, just using these correlation tables. Oh yeah, that's right. I was going to show you how to do correlations as well. If you want to know how to determine correlations for yourself, so that you can do this, all you need to do is go to the indicators section, type in correlation, you'll get the correlation coefficient, and it's the built-in one. And the asset that you'll want is BTC USD. Any one will do. Apply that bad boy. And then when you go to, say, stocks, and you adjust this for 15 days, 0.56, 0.57. You can see they're basically the same. USD, negative 0.15, negative 0.8. They're quite close enough that you'll be able to get a decent amount of signal out of it. And you can go ahead and just do that for all the different assets that mean something, which is essentially this list here. You can go down through the assets and have the different time horizons and populate this entire chart yourself using free tools. Like I said as well, the MyFractal Range website, they provide free risk ranges, so you can use those if you want. Like I said, I use the Hedgeye ones, so let's have a look. Portfolio. Nope, it's not there. All right. So, but yeah, you can use the Hedgeye ones if you want. You can use the free ones if you want. It's up to you. But yeah, cross asset macro analysis forms a large part of my analysis personally, and yeah, I like to use that in combination with all my other indicators. So, with that all being said, please prepare for unit number 7, where we aggregate the data from previous units into a practical system. If you have any questions or thoughts or anything, please jump into the crypto general chat or crypto questions and hit me with the @ tag. Now, I want you guys to just be all right with this, because towards the end of the masterclass, we're going to be going through this multiple times again, and I'm going to be doing complete analysis, like from front to back, current market updates, and all that type of shit. I just wanted to get this masterclass kind of fleshed out first, so that you guys have an idea. Your minds are prepped for what I'll be throwing at you when we get a little more complicated, when I do the full market analysis. Basically, what I want to do is get you guys to the point where when I do my full market analysis at the very end, and I go from front to back and I use my full system, you'll know exactly what I'm talking about, because my method I would say is quite complex, like incredibly complex, but the point is that with any of the data, or even if you know like maybe half of what I know, you'd still be able to make tons of money. So yeah, just stick with it. It's I promise when we get to the end, it's probably not going to be as complicated as you think it's going to be. It's still going to be quite complex, but you're not going to need to memorize too much. We're going to be making spreadsheets and shit and systems so that you won't need to think too hard at the very end. Anyway, that being said, thank you very much, guys. I'll talk to you soon.